When a stock falls hard, most people ask the wrong question first. They ask, why is the price down? That is not the first question. The first question is, did the business actually get worse, or did the crowd simply get more afraid? That distinction is where fortunes are made, and it is also where most people fail because a falling price is visible, fear is visible. A red screen is visible, a bearish article is visible, an ugly month is visible. What is much harder to see, especially when people are panicking, is whether the engine underneath the stock is still compounding or whether it has started to break. That is the only thing that matters to me in the long run. I have said for most of my life that the market is there to serve you, not to instruct you, but very few people actually live that principle when prices start falling. They love the sentence when the stock is rising, they quote it, they post it, they nod along with it, then the stock falls 15%, 20%, 25%, and suddenly the market stops being a servant and becomes a judge in their minds. That is the trap. A stock dropping is not a verdict. A stock dropping is an event. You still have to decide what kind of event it is. Is it the market marking down a deteriorating business? Or is it the market offering you a stronger business at a weaker price because sentiment is soft, because fear is loud, because a prominent critic has captured the microphone, or because a broader sell-off has dragged good and bad names lower together? That is the frame I want you to hold all the way through this discussion, because if you lose that frame, you start behaving like a spectator, and spectators do not build real wealth in markets. Spectators react. Owners investigate. Now let us begin with the thing everyone notices first. Palantir has fallen over the past 6 months. It has fallen hard enough to make recent buyers uncomfortable. Over the past month, it has fallen hard enough to create headlines, panic, and the usual parade of people announcing either the death of the company or the arrival of the buying opportunity of a lifetime. I have no interest in either kind of theater. I am not here to celebrate pain, and I am not here to comfort people with slogans. I want to know one thing: has the business cracked? Because if the business is cracking, the lower stock price may still be too high. If the business is strengthening while the stock price weakens, then I start paying very close attention. That is how I have always thought. A wonderful business at a cheaper price is a different proposition than a broken business wearing a markdown sticker. One is opportunity, the other is bait. And in this case, a great many people are trying to answer that question through emotion instead of arithmetic. They see the stock down. They see articles turning darker. They see the market nervous about Iran energy, AI valuation, and risk appetite. In general, they see a famous critic attacking the company. Then they combine all of those feelings into one emotional conclusion. Something must be wrong. Something may be wrong, but that is not the same thing. A serious investor does not move from noise to conclusion that quickly. A serious investor asks, what would I expect to see if the bearish case were actually true? That is where the whole thing becomes much simpler. If Palantir were truly being destroyed by competition, what would you expect? You would expect revenue growth to slow badly. You would expect margins to compress. You would expect free cash flow to weaken. You would expect contract momentum to erode. You would expect talent to leave. You would expect management to lower expectations. You would expect balance sheet quality to deteriorate. You would expect institutions to lose interest or quietly lighten exposure. You would expect the business itself to show stress before you accepted the market. Stress is intelligent. That is the first discipline. Always define what must be true for the bear case to deserve your respect. Otherwise, you are not analyzing. You are absorbing. And the market is full of people who absorb narratives because it feels like thinking. Now I want to address the central criticism head on, because there is no use pretending it is not part of the current pressure on the stock. The criticism is that Palantir's moat is weaker than people think, that newer AI tools and companies like Anthropic will make Palantir's platform less necessary, less differentiated, less powerful over time. Fine. I do not mind criticism. In fact, I insist on it. The only investors who should fear criticism are investors whose conviction depends on never having their ideas tested. I have always found that a stock with no critics is usually a stock surrounded by fragile enthusiasm. Criticism is useful. Criticism is healthy. Criticism pushes you to clarify whether you are holding a belief or merely holding a mood. So let us grant the critic his strongest position. Suppose a newer AI model is powerful. Suppose it is useful. Suppose it is cheaper in some contexts. Does that automatically mean it will replace Palantir? Number that leap is far too fast. Powerful tools do not always replace integrated systems. Often they simply occupy a different layer of the stack. This is where a lot of people confuse capability with deployment. A model can be brilliant and still not be the same thing as an enterprise grade deeply integrated decision platform embedded across government, defense, intelligence, and large commercial operations. A toothbrush can put paint on a wall. That does not make it a painting company. That image may sound almost too simple for an adult conversation about enterprise software. But simplicity is exactly what cuts through most of the nonsense here. The question is not whether another AI company can produce clever outputs. The question is whether those outputs can scale across complex institutions, integrate across fragmented data environments, survive security requirements, embed into high-stakes workflows, align with mission, critical accountability, and replace existing trusted systems without introducing more risk than value. That is a much harder problem than simply being smart. This is what many people misunderstand about enterprise and government software. The hardest part is not always intelligence. The hardest part is operationalization. It is not enough to be brilliant. You must become embedded, you must become reliable, you must become governable, you must become trusted inside messy organizations where one bad failure matters more than 100 small wins. That is why replacement is rarely as easy as critics imply. A system that sits at the center of institutional decision making is not displaced just because a smarter sounding tool appears. Displacement at that level requires migration, retraining, trust transfer, procurement risk, internal buy, in data integration, security confidence, and operational proof. That is a long road. And if the business being attacked is still strengthening while that argument is being made, then I do not take the attack at face value. I take it as a hypothesis that must be tested against numbers. So let us test it. Because the beautiful thing about investing is that eventually stories must pass through arithmetic. If the competition thesis were working its magic against Palantir, revenue growth should already be weakening. Instead, the revenue growth has remained extraordinarily strong. That does not prove the future forever, of course nothing does, but it absolutely undermines the claim that the business is already being structurally damaged in the way the stock action seems to imply. If the company were getting boxed in competitively, you would expect profitability to suffer as it fights for business, discounts harder, spends more aggressively, or loses operating leverage. Instead, operating margins have expanded violently upward. That matters more than people realize. Rising margins during a period of intense scrutiny tell you that the underlying economic machine is not merely surviving. It is becoming more efficient as it scales. That is not what you see in a business being quietly suffocated. That is what you see in a business beginning to show the power of operating leverage. People talk endlessly about revenue growth because it is easy to understand. They talk less about what happens when profit growth begins outpacing revenue growth. That is one of the most important signs in all of business. It means the company is not just selling more, it is becoming structurally stronger. The same logic applies to free cash flow. If a company is really under competitive siege, free cash flow often begins wobbling even before the narrative admits it. Why? Because cash is less forgiving than stories. A company can say a lot of things about future positioning, but if real money stops showing up, eventually the truth arrives. In this case, free cash flow has not weakened, it has surged. And that is a brutally inconvenient fact for the bearish narrative because you can argue about vision, you can argue about product philosophy, you can argue about whether another AI platform looks sexier or cheaper or more interesting. But when the actual business keeps converting more and more of its sales into hard cash, the critic has to explain why a supposedly endangered business is getting richer, more efficient, and more liquid at the same time. That is a hard explanation to give, honestly. Now I want to go one level deeper because this is where the quality of the balance sheet enters, and the balance sheet is one of the most underappreciated sources of investing calm. People talk constantly about growth. They talk too little about survival power. A business with weak liquidity and heavy debt can be a beautiful story and still become a miserable stock the moment the environment turns against it. A business with enormous liquidity, low debt, and strong cash generation behaves differently under pressure. It does not need the market's kindness to remain alive. It does not need to refinance desperately. It does not need to beg for patience. It can outlast fear. And outlasting fear is one of the best businesses in the world, Palantir. balance sheet is not merely good, it is absurdly strong. You can call that conservative if you want. I call it strategic oxygen. Cash is not just optionality for investors, it is optionality for management. A company sitting on vastly more cash than debt, while also generating strong free cash flow, is not a company being dragged to the ledge by competition. It is a company with room to invest, defend, recruit, acquire, and endure. That matters enormously in technology, because technology winners do not always win by having the cleverest demo. They often win by surviving long enough, integrating deeply enough, and funding their own expansion without ever becoming hostage to the credit markets or public sentiment. That is what strong liquidity buys you time. And time is often the deciding variable in business competition. Now let me say something else that people forget. Whenever a stock starts falling and the crowd begins demanding immediate certainty, a stock can be down because the market is weak. A stock can be down because the sector is weak. A stock can be down because its multiple was too hot and sentiment cooled. A stock can be down because a famous critic published a thesis that frightened recent buyers. A stock can be down because all of those things happened at once. None of those explanations automatically requires that the business itself be deteriorating. This is where most investors collapse into confusion. They assume that if the price and the narrative are falling together, then the business must be following close behind. Sometimes it does, sometimes it does not, and that is exactly why long-term investors make their money in environments like this, because the market is constantly confusing its emotional timetable with the company's operating timetable. The market can turn fearful in a week. A business moat either strengthens or weakens over much longer periods. The market can collapse a multiple in a month. Cash flow quality evolves more slowly. The market can become obsessed with one bearish voice. Customer contracts, operating leverage, retention, talent density, and balance sheet superiority follow their own clock. That clock is the one I care about. Now let us talk about institutions, because I have spent my whole life learning one rule that has saved me a great deal of pain. Do not pay too much attention to what powerful people say in public if you can observe what they are doing with actual money. Words are cheap. Positioning is expensive. Institutions have been publicly skeptical about Palantir for quite a while. Many of them have repeated the usual valuation complaints. Many have treated the company as overhyped, too expensive, too controversial, or too difficult to value with comfort. And yet, when you study who has been accumulating ownership, the behavior tells a more interesting story. Institutional ownership has risen, not collapsed. That is important, because the institutions with the deepest research budgets, access, and patience are not always right. But they do not casually load into a business they believe is disintegrating at the core. If they were truly convinced the economics were collapsing, the ownership pattern would look very different. Again, this does not prove the future forever. I am not childish enough to say institutions buying is a guarantee, but it matters when their public caution exists alongside continued accumulation. That gap between stated caution and actual positioning is often one of the most revealing clues in markets. The crowd listens to what is said. The serious investor watches what is owned. And right now that distinction matters a great deal. Now I want to come to valuation, because this is where otherwise intelligent people lose their balance and start acting as though one truth cancels the other. Can Palantir be a great business and still be expensive? Yes. Can a stock fall because sentiment is correcting an overheated multiple even while the underlying business remains excellent? Yes. Can both of those be true at once? Absolutely. That is one of the reasons this conversation gets so emotionally chaotic. One camp wants to say the business is incredible, so the stock must be a buy at any price. That is foolish. The other camp wants to say the stock fell, so the business story must have been fake. That is equally foolish. A real investor has to be able to hold both truths in his head. The business can be elite. The stock can still go through painful repricing. The right question is not whether the stock once looked too hot. The right question is whether the current price now offers a better bargain relative to the current quality and future economics of the business than it did 6 months ago. That is how adults think, not with slogans, with relationships between business quality and price. And what makes the current setup interesting is precisely that relationship. The business metrics have improved while the stock price has weakened. That is not proof by itself, but it is the kind of divergence I care about, because if it persists, it creates a setup every long-term investor should recognize: falling price, rising business. That combination is where many of the best opportunities begin. Now, I am not here to tell you to buy blindly. I hate blind conviction. Blind conviction is just another name for ego. You should never own a stock simply because someone else sounds confident. Whether that person is bullish, bearish, famous, anonymous, loud, polished, or persuasive. You must do the harder work of building your own conviction from the ground up. That means understanding what would make you wrong. It means understanding what numbers would break the thesis. It means understanding what signs of competitive deterioration would matter. It means knowing whether you own a business or merely a narrative. That is why I care so much about systems. Without a system, you are just a tourist inside your own portfolio. You buy because somebody sounded smart. You sell because somebody else sounded scary. You call that research because it makes you feel less helpless. It is not research. Research is when you know exactly which variables determine whether the business is improving or weakening, and you revisit them consistently enough that price volatility cannot easily bully you into abandoning the process. That is what allows you to buy in the painful stretches. And the painful stretches are where the money is usually made. I know people do not like hearing that because it sounds too simple, but simplicity does not make it false. No stock goes straight up. Every great company gets questioned. Every great stock gets cut down violently. At some point, if your whole emotional structure depends on stocks always validating you in real time, you are going to fail in growth investing. Growth investing requires two things most people do not naturally possess: the ability to endure volatility without rewriting the thesis in panic, and the ability to separate a temporary hit to sentiment from a true fracture in the business engine. That is why I say again and again, the market is not here to comfort you. It is here to test whether you are an owner or an observer. An observer sees a 25% decline and asks whether the journey is over. An owner asks whether anything material in the company's compounding engine is actually broken. If nothing material is broken, he becomes more interested, not less. That does not mean reckless. It means more interested. Now, let me give you the real framing question I would ask if this were my capital and I had to decide what to do. Suppose Michael Burry is wrong. Suppose the business is not being meaningfully disrupted in the way the criticism suggests. Suppose the company continues doing what the numbers say it is already doing, growing revenue hard, expanding margins, gushing free cash flow, preserving a fortress balance sheet, keeping talent, winning work, and strengthening institutional ownership. If that is true, then what do you have? You have a business climbing while its stock declines. That is exactly the setup long-term investors should pray for. Now suppose the bearish case is right. Suppose revenue meaningfully decelerates. Suppose margin expansion reverses. Suppose free cash flow weakens. Suppose management loses the thread. Suppose the moat turns out to be narrower than believers thought. Then the lower stock price is not an opportunity. It is merely the first leg of a longer truth. That is why numbers matter. They protect you from ideology, and I care more about protection from ideology than I do about being part of a tribe. I do not want an echo chamber around any stock. That is how people end up worshiping companies instead of owning them. The minute you begin treating a business like an article of faith, your mind becomes useless at precisely the moment it is most needed. Respect the criticism. Study the business, watch the numbers, then decide. Now here is my own conclusion. I do not see the arithmetic of a business being killed. I see the arithmetic of a business still getting stronger, while fear, valuation pressure, market weakness, and a high-profile critic have created a much harsher emotional environment around the stock. That is not the same thing as no risk. There is always risk. It is simply a different category of risk. The current risk looks less like business decay and more like market psychology colliding with an expensive name. And if that collision gives disciplined investors a lower cost basis, while the engine underneath the company keeps improving, then I understand exactly why some people are becoming more bullish now. Not less. This is the part inexperienced investors always find hardest to accept. The best time to buy a business is often when the story feels most uncomfortable, but the numbers still refuse to break. That is what separates conviction from excitement. Excitement loves green candles. Conviction is built in red months by people who know what they own. So the final question is not, is the stock down? Of course it is down. The final question is not, is a famous critic bearish? Of course a critic can be bearish. The final question is this: do you have a strong enough system to tell the difference between a declining stock and a declining business? Because if you cannot answer that, then it does not matter whether the critic is right or wrong, you still are not ready to own something like this. But if you can answer it, if you can read the numbers, study the engine, weigh the balance sheet, examine the operating leverage, and compare that against the stock action without letting your emotions play judge and jury, then environments like this stop feeling frightening. They start feeling useful. And that is what long-term investing really is. Not prediction, not loyalty, not ego, useful discomfort in exchange for future compounding. That is the whole game. Everything else is just noise around the edge.